In this video, I'm going to share with you what I think will be the top 3 cryptocurrency for the next bull market. Crypto is all about narratives and problem solving. With hundreds of projects to choose from, I found the highest quality projects that have massive upside potential. If you want to know what is the next narrative that can generate great returns, then keep watching. Over recent months, DeFi has been captured by a new narrative focused or centered around protocol that can generate real yield. Before we talk about the real yield narrative, we need to understand the evolution of the scene since 2018. Maker Dao and Compound were two of the most popular DeFi projects that emerged in 2018. But the whole DeFi scene really took off in 2020 when Compound issued the Comp token to reward the user or investor for providing liquidity to the protocol. This era of crypto was called DeFi summer. This period was an exciting time of yield farming mania, where many projects were launching tokens and offering amazing yields to the users. It was absolute madness. This new liquidity sourcing model really helped the industry take off, and it was a fantastic time to be involved. However, as time passed by, it became clear that this model was not going to be sustainable for the long run. Liquidity began to dry up across DeFi as users started to disappear from these platforms. As a result, many DeFi tokens significantly underperformed ETH throughout the 2021 bull market. This liquidity mining model was flawed because it was based on excessive emissions of the protocol's native token rather than the sharing of organic protocol profits to the users. After the 2021 bull run, a bunch of projects came up with idea for a better way to structure these DeFi protocols in a healthy, sustainable way. And the real yield narrative was born. The term real yield refers to protocols that incentivize token ownership and liquidity mining by sharing the profits generated from the fees. This new DeFi model has been implemented in the derivatives market. And for those who don't know what derivatives are simply a financial contract that derive their value from the underlying asset or group of assets. Some of the most popular derivatives are futures contract, option contracts, and swap contracts. The derivatives market is gigantic and is estimated at over $1 quadrillion on the high end. This is largely because there are numerous derivatives in existence or contract available on virtually every possible type of investment asset, including equities, commodities, bonds, and currency. The added value on chain or on the blockchain with these financial products could be insane if these contracts could be settled in a more decentralized way or in decentralized platforms. The crypto derivatives have been growing and expanding steadily both on centralized and decentralized exchanges. Additionally, due to the FTX disaster, a lot of users have lost trust in centralized exchanges, and they are making the transition towards decentralized exchanges to have the access to derivatives products. GMX is a decentralized spot and perpetual exchange on Arbitrum and Avalanche. Since launching in 2021, GMX has quickly accrued a lot of liquidity and seen its trading volume soar. The project is in the 6th position when it comes to revenue generated from fees, according to cryptofees.info. This means that people are actively using the platform. Besides the apparent product market fit, a large part of the success of GMX is linked to the revenue sharing model. The project has two native tokens, GLP and GMX. GLP represents an index of the available assets for trading on the platform, while GMX is the project's native governance and revenue sharing token. 70% of the exchange trading fees are paid to the liquidity providers or GLP token holders in form of ETH on Arbitrum and Avalanche, and the remaining 30% goes to GMX stakers. The project offers currently a 16% APR for staking GMX. This yield is secured through organic profit sharing rather than dilutionary token emissions, and has proven to be attractive for liquidity providers and governance token holders. Because of this model, GMX has accrued most of the liquidity on Arbitrum, with over 650 million in total value locked on chain, and has one of the highest staking rates for its governance token trillion in the asset classes, with around 71% of its total supply being staked. The Arbitrum ecosystem is booming and I'm super bullish on this project. Many investors have missed the boat on GMX, but this project could give you a second chance at getting early in the real yield narrative. This project is a decentralized exchange with advanced perpetual trading capabilities, community-focused incentives, and scalable infrastructure. This platform was specifically created to overcome familiar DEX or decentralized exchanges issues like front-running, slippage, asset limitation, and the lack of risk management features. This is one of the things that retail investors need to understand. Most of the gains in crypto come from projects that solve the problems that were evident in the past cycles. Centralized exchanges like Binance, Kucoin, and Bybit provide seamless trading experience and access to many different products, but no self-custody. Self-custody meaning you're not the owner of your crypto after you buy it if you keep it on the exchange. Decentralized exchanges, on the other hand, provide self-custody trading but poor user experience and poor choice in trading products. The project that I'm talking about is called VELA Exchange. It's a self-custody driven spot and perpetual DEX or decentralized exchange aimed to close the gap between centralized and decentralized exchanges. The VELA Exchange will have three main products: perpetual exchange, fully on-chain order book, perpetual exchange where users can create position against synthetic assets with up to 30x leverage. Users can deposit stablecoins such as USDC as collateral. Spot exchanges, fully on-chain order book exchanges where users can trade assets depending on available spot markets. A decentralized peer-to-peer OTC trading platform where users can trade assets publicly or privately, avoiding slippage or front-running. As part of the real deal narrative, the fees generated from the perpetual exchange are split as follows. 50% goes to the VLP vaults, 20% goes to the eVela rewards, meaning 10% for staking VELA and eVela, and 10% staking VLP, 5% in USDC rewards for stakers of VELA and eVela, 25% goes to the treasury. The team has been in the crypto space since early 2010, and some of the members are core contributors to various major DeFi protocols like Balancer, Benki, Rome Blockchains Labs, and other DeFi teams. This project could face some serious competition from other projects in the perpetual DEX space, but they can definitely achieve success by offering projects that have better UX, better functionalities, and a big range of trading pairs. This crypto project has a DeFi ecosystem with multiple products on the Polygon and Arbitrum chains. The name of the project is GNS Network, ticker symbol GNS. One of the most prominent features of this project is G-Trade, which is a decentralized leverage trading platform to facilitate crypto and non-crypto trades. This decentralized leverage trading platform allows users to trade stocks, crypto, and forex. The platform currently offers more than 45 crypto pairs with up to 150x leverage, forex pair with up to 1000x leverage, and stock pairs at up to 150x leverage. And obviously, the number of pairs will continue to grow as the platform expands in order to satisfy the demands from traders. In addition, users of GNS Network do not need to participate in any KYC identification to get started. But how does the G-Trade platform works? Because synthetic leverage is used in the GNS Network G-Trade, users do not actually borrow their funds to take advantage of leveraging their trades. When an order is placed, positive trades are paid through the vault and negative trades result in funds being deposited in the vault. G-Trade operates on the Polygon chain but uses Chainlink to power its leverage trading. This chaining price feature allowed the platform to provide real-time aggregated prices for its suite of trading products. GNS offers users a great way to earn passive income. In exchange for staking GNS, users are rewarded through DAI generated from trading fees. Approximately 32.5% of the trading fees collected on the platform contribute to the GNS staking rewards. The native token of Gain's network is GNS, which is a deflationary utility token. When traders lose, which is something that happens basically all the time, DAI stablecoin is sent to the collateral vault, which then burns GNS when the excess collateral ratio reaches 130%. To date, roughly 20% of Gain's tokens have been burned. The initial supply was 38.5 million tokens. There is a supply cap of 100 million tokens. However, there is a mechanism that is used to ensure that the supply will never reach 100 million. 70% of all GNS is staked by the user to get that sweet passive income from the platform fees. Staking GNS on Polygon gives users an APR of 3.57%, and staking on Arbitrum gives you a 5.67%. These percentages might change based on the performance and adoption of the platform. Like GMX, holding GNS can be seen as having a stake in a casino. And the casino of trading is a profitable endeavor for the owners. Historically, 90% of traders lose, and this has been the case overall for GNS. This narrative in crypto has some serious potential, and I wanted to share my perspective and research on it. In the description, you will find some links where you can buy these tokens. Thank you for watching, and I guess I will see you in the next one.